Welcome to this series on the Pandemic Risk Insurance Act of 2020, where we will take a constructive but critical look at H.R. 7011 and other proposals to establish a pandemic insurance program. This is your host, Jason Shoup, founder and managing member of the Centers for Better Insurance. Episode 1, the Federal Backstop. Let's start with a high-level overview of the proposal. U.S. Treasury would administer the Pandemic Risk Insurance Act, or PRIA, just as it administers the Terrorism Risk Insurance Act today. At a high level, both programs are intended to open up commercial insurance markets to take on hard-to-insure catastrophe exposures. They do this by requiring insurers to make their policies available without an exclusion, limitation, or other special condition for pandemic or terrorism, respectively. In exchange, the program promises to reimburse participating insurers for a certain amount of losses from those events. This reimbursement is known as the federal backstop. In this episode, we will compare the federal backstop proposed for the Pandemic Risk Insurance Act with the current backstop structure under TRIA. The insurer deductible is the foundation of the backstop. The insurer's obligations under the deductible are calculated as a percentage of its prior year direct earned premiums from relevant lines of commercial property and casualty insurance. For TRIA, the insurer deductible is 20% of direct earned premium. Each insurer or group of affiliated insurers has its own individual deductible. For TRIA, those deductibles range from $100,000 or even less for captive insurance companies to more than $2.5 billion for traditional insurers. If we added together all of TRIA's individual insurer deductibles, they would total about $50 billion. Insurer's deductible under PRIA would be quite a bit smaller, 5% of the insurer's prior year direct earned premium. For individual insurers, such as captives, the deductible may be as low as $25,000. Large diversified insurers are looking at a deductible of about $650 million under the proposal. The sum of all individual insurer deductibles under PRIA would be about $12 billion. Above the insurer deductible sits the federal share. The federal share is Treasury's promise to reimburse participating insurers for a portion of the claims they pay under the program. For TRIA, Treasury would reimburse 80% of claim payments above an insurer's deductible. The remaining amount, in the case of TRIA 20%, is known as the insurer co-share. Under the Pandemic Risk Insurance Act proposal, the federal share expands to 95% of losses above the insurer deductible. Correspondingly, the insurer share shrinks to 5%. TRIA also has a $200 million program trigger. If the program trigger has not been met through total industry insured losses from all acts of terrorism in a single calendar year, the backstop will pay nothing, even if an individual insurer has satisfied its deductible. PRIA increases the program trigger to $250 million and applies it per certified pandemic, not per calendar year, as is the case in TRIA. Finally, the federal backstop is capped. Once insured losses from covered events occurring in any one calendar year reach the cap, neither Treasury nor insurers have any further obligations to make claim payments. If it appears the cap would be reached, Treasury orders insurers to prorate claim payments. In other words, pay insurance claims cents on the dollar to stay under the cap. For TRIA, the liability cap is $100 billion per calendar year. The Pandemic Risk Insurance Act proposal substantially increases the liability cap for that program to $750 billion of total insurer and federal losses paid as a result of pandemics in any one calendar year. As we compare the dimensions of the Pandemic Risk Insurance Act's insurer deductible, federal share, and liability cap with those of the Terrorism Risk Insurance Act, the magnitude of this proposal becomes clear. The scale of PRIA is all the more impressive because it would only encompass business interruption and event cancellation losses. TRIA covers these, but also covers property damage, workers' compensation, and liability claims. We will continue to look at the elements of PRIA and other proposals for pandemic risk insurance programs in subsequent episodes. In the meantime, you can learn more about the Pandemic Risk Insurance Act and the Terrorism Risk Insurance Act at betterins.org. On behalf of the Centers for Better Insurance, thank you for taking this time.